Have you ever noticed your loan payments or FD returns change unexpectedly? This isn't random. It's the Reserve Bank of India, or RBI, changing interest rates. This video will show you how to adjust your money when the RBI changes the rules. The RBI sets the repo rate, the rate at which it lends money to banks. Banks borrow from the RBI to fund customer loans. This cost is then passed down to you. A higher repo rate means banks borrow costly, and you pay more interest. A lower repo rate means banks borrow cheap, and you pay less interest. Interest rates create a seesaw effect. When rates rise, loans become expensive, punishing borrowing. At the same time, saving becomes highly rewarding. You must adjust both sides of the seesaw every time the RBI changes rates. Timing is crucial. Home loans are highly sensitive to rate hikes. A small increase, such as from 8.0% to 9.0% on a 30 lakh rupees loan, can significantly jump your EMI or magically extend your loan tenure by years. To manage this, choose floating rate loans only if you can handle the fluctuations and actively refinance your loan when the rate cycle drops. Unsecured debt, like personal loans and credit cards, immediately become toxic during rate hikes. The interest rate on a personal loan can quickly rise. Credit card rates stay astronomically high, and bank approval criteria tighten drastically. The playbook here is to prepay existing personal loans, pay credit card bills in full, and avoid new unsecured loans during high rate periods. High rates create a window for guaranteed returns. Fixed deposit, or FD, rates can move from a sluggish 6.0% up to an attractive 7.5%, making your idle cash earn much more. Savings accounts see only slight increases. Lock your money in FDs when rates peak, and avoid long-term FDs during low-rate cycles. In a cheap money environment, low interest boosts business expansion, and markets usually rise. In an expensive money environment, high interest tightens corporate margins and slows borrowing, which can slow down market growth. The key is to keep investing regardless of rate changes to capture the eventual upcycle. For loans, when rates go up, prepay early and avoid new debt. When rates go down, refinance for better rates. For FDs, lock in long-term FDs at peak rates and keep durations short when rates drop. For the market, keep SIPs active during the slowdown and ride the market momentum when rates are low. A rate hike costs real money in a monthly budget. In this example, a rate hike increases the home loan EMI and cuts the monthly savings. However, the FD return also goes up. Ravi's smart move is to use the higher FD return to entirely offset his EMI loss. Banks do not immediately pass on cuts or hikes. They take time to adjust. This lag creates an action window, giving you a brief period to lock in favorable rates before your bank updates its pricing. Floating rate loans react faster, while FD rates lag. There are 5 traps to avoid during rate changes: ignoring EMI changes, taking on new unsecured loans, locking money into long-term FDs when rates are low, stopping mutual fund SIPs, and failing to compare refinancing options when rates drop. To track and optimize your money, track RBI monetary policy meetings every 2 months. For investments, use apps to automate SIPs. For loans, compare refinancing options and use EMI calculators. For savings, check FD rates across multiple banks and keep emergency funds in liquid funds. RBI interest rates directly control your money flow. If you ignore this, you lose money silently. If you use it smartly, you can stay ahead. Track the rates, adjust your strategy, and win the cycle. Small decisions here can save lakhs over time, leading to debt optimized and savings maximized.